So you want to invest, but you've never done it before and you have absolutely no idea where to start. Don't get overwhelmed, don't panic. Just watch this video and you'll feel a lot better with making that first investment decision. Let's go.
I work hard each and every day. I get lost in the words I say. I don't push pause, no, I push play. I won't stop till I make a change.
Hey everyone, it's Lewis back again with another video, and today I've got quite a big one for you. A complete beginner's guide to investing in the stock market for 2022. So I feel like explaining the stock market should be a whole other video in and of itself, but briefly, the stock market is where people, or the majority of people, go to invest their money. This is because time has proven, more than 100 years worth of it by the way, that the stock market is the most proven track record, or at least has the most proven track record for growing people's money for the long term. Now the stock market is where publicly traded companies are listed. For example, Apple, the world's biggest company by market cap, is on the stock market in the USA. Each company that is listed on the stock market is split into little pieces which are called shares. So for each share of a company that you own, you literally own a piece of that entire business. For example, if you buy one share of Tesla, you will own a piece of Elon Musk's company. Now this doesn't mean that you'll get a seat on the board of directors, and you'll probably only own one headlight of a Tesla car, but you get the idea. So think of companies on the stock market as a pie. Each person who owns a share or several shares of a company has a slice of that pie. Now there are several stock markets all over the world. If you want to invest in American companies, there's the New York Stock Exchange. Over there you'll find the likes of Apple, Amazon, Tesla, Google and Microsoft. If you want to invest in British companies, we have the London Stock Exchange, which lists the likes of BP, Tesco, Barclays Bank and HSBC. You get the idea. Generally speaking, companies that are from that country are listed on that country's stock exchange. And within these stock markets are entire stock indexes, such as the S&P 500 in the US, which lists the 500 biggest companies in America, and the FTSE 100 in the UK, which again lists the 100 biggest companies in Great Britain. And there are stock markets all over the world. They used to be just physical buildings where people would go to trade these stocks, and to an extent they still are. These buildings do still exist, people still trade inside of them, but they're nowhere near as busy as they were anymore, thanks to the dawning of the smartphone, because we now have entire stock markets in the palm of our hands. Well, the reason why people invest is to make money. Putting all of your excess money that you have left over after your expenses every month in cash savings isn't going to grow your money at all. In fact, thanks to inflation each year, the value of the cash in your pocket or in your bank account is eroding away. The purchasing power of your money is falling. Think about how much of a loaf of bread cost 30 years ago compared to now, for example. This is how inflation, in its simplest terms, works. But by putting your disposable income into the stock market instead, you can outgrow inflation several times over and become much richer for it. Well, it's simple, but so many people don't realize this. You simply must have a financial foundation set before you even begin to think about investing. Look, the average annual return of the S&P 500 that I mentioned earlier is 10.5%. This is the benchmark for all other stock market indexes and fund managers all over the world. However, the average annual return of other stock market indexes is quite lower, averaging around 7 to 10%. So if you have any high cost debt that charges a higher interest rate than, I would say, even 5%, get rid of it before you even consider investing. You cannot invest whilst you're in debt. If you have a credit card debt that charges 25% interest, but you're only making 7% on your stock investments, you're doing it wrong, because you've still lost 18% of your overall money thanks to the debt weighing you down. Warren Buffett said it best himself. The only guaranteed 20% plus return on your money is by paying off any of your high cost debts. And that's not all you need to have in place before you even begin to think about investing. Having an emergency fund saved in an easy or instant access cash savings account is also crucial. This will crucially ensure that you no longer have to go into debt again or sell out of your investments to cover for a household expense. The general consensus is 3 to 6 months of emergency expenses saved, so get this in place before you start investing. Alright, there are plenty of ways to do this, but the easiest, most convenient, and usually cheapest way is to use a stock market trading platform such as Trading 212, Free Trade, Stake, or several of the other ones out there. This is all about dealer's choice, really. It's all about what you want access to. If you want to invest in the UK stock market, Trading 212 and Free Trade will probably be great options. If you want to invest in the US, you might consider Stake, as they actually provide people in the UK with access to US traded stocks and ETFs that are otherwise not available in this country. It is completely up to you, but it massively pays to do your own research here, as I can't really tell you where to go at all. Alternatively to these platforms, you can also invest via the more, shall we say, traditional investment platforms such as Vanguard and Hargreaves Lansdown. However, there is a little bit of a caveat to these. Some of them can charge much higher fees than the aforementioned trading platforms, so do keep an eye out for those. Not at all. This again completely depends on the platform of your choice, but you can actually start investing from as little as £1 with the likes of Free Trade and Trading 212. The more traditional platforms generally want much more of a down payment, so to speak, with some of Vanguard's funds requiring you to begin with £500 minimum. But again, please research this yourself, because you may have quite a bit of money saved up doing nothing that you can just put into a stock market straight away. But don't get bogged down by the fees, and understand what you're investing in before doing this, even with as little as £1. This again is completely up to you. I can't tell you where to put your money. However, as a general guide, you can invest in either single shares of companies that I mentioned before, or you can invest in entire stock market indexes that I've also mentioned. This is because a lot of companies, such as Vanguard and BlackRock, provide what are called exchange-traded funds, which are known as ETFs. ETFs trade like single companies on the stock market. However, they actually track entire indexes, such as the S&P 500. So you don't have to have all of your money in one company. You can have it in 500 individual companies, which spreads your risk and keeps you nicely diversified in different sectors such as tech, financials, and consumer staples. Putting all of your eggs into one basket is obviously more riskier, but the rewards could be greater. You could just as easily invest all of your money into Apple, but you need to know what you're doing here. Don't just look at Apple's recent track record and think that you're going to get a guaranteed return of around 800% just because they've done that in the past decade. Times change and companies change. If you want to buy shares of individual companies, you need to know these companies like the back of your hand. Study their balance sheets, listen to their earnings calls each quarter, understand their products and services, all that kind of stuff. If you don't want to do that, or if you simply don't have the time to do that, you can invest passively into the stock market by investing in a low-cost ETF, which tracks an entire market or an index and will grow with the average of the companies it's tracking over time. I personally hold very little amounts of money in single company stocks at the moment. In fact, at the time of this video going out, I only own one company that I've bought myself, which is American Express. I have other single shares that I've received from referring people to the likes of Stake, Free Trade, and Trading 212, which you can do yourself by using the links down below in the description to get yourself a free share too. But I don't buy these companies myself. I'm simply awarded those companies for referring people. The majority of the money that I invest myself is in ETFs. So dividends are the golden nuggets of investing in the stock market. Essentially, if a company's stock or even an entire ETF pays out a dividend yield, you'll be paid that percentage each month, quarter, or year that you hold the stock or ETF for. For example, I hold stock in American Express. They currently pay a dividend yield of 1.15%. So for every one share that I own of American Express, I'll be paid 52 cents just for holding it. It's paid out in cents because American Express is, funnily enough, an American stock. But it's the same principle for ETFs as well. For example, Vanguard's S&P 500 ETF, VUSA, pays a dividend yield of 1.14% at the time of this video going out. So for simply investing passively in the 500 biggest companies in America, you're getting paid 1.14% of each share that you own in this ETF, plus the overall percentage growth of the stock or ETF that you hold each year. How amazing is that? What's even more amazing is that investing platforms such as Trading 212 allows you to turn on a dividend reinvesting plan, which is also known as DRIP, so that every time a dividend is paid to you, it will simply be reinvested back into the stock that you're invested in. This grows your compound interest even more and makes your investments become, quite frankly, an unstoppable force of nature. Albert Einstein called compound interest the eighth wonder of the world, and with this you can definitely see why. Great point. Yes, I do actually. Now this is absolutely crucial when it comes to investing in the UK. Here we have a tax-free investment allowance each year, which is £20,000. So you can open one stocks and shares ISA each year, or each tax year, which runs from the 5th of April to the 6th of April each calendar year, and put a maximum of £20,000 into that, and any money that you make from it is completely tax-free. You should absolutely make the most of your allowances, and that's exactly what I'm doing going forward. If you want to know everything there is to ISAs, you can check out my ultimate guide right here. Well, generally speaking, you should only invest money for a very long period of time. I'm talking tens of years. This is because compound interest works much better and much stronger the longer you have money invested. Compound interest is essentially the money you have gaining interest, and then that interest making more interest on top of it. Think of it like a snowball running down a hill. The longer that snowball runs, the more snow it collects, therefore the bigger it gets. So the longer you have money invested into the stock market, the more interest you'll make, the bigger your snowball will be. One of the greatest pieces of advice in the investment world is very simple. Time in the market beats timing the market. There are plenty of strategies to adopt when it comes to investing. Now, you may have some money saved up or inherited. Let's say it's £10,000. If you were to put all of that money into the stock market as one lump sum and then let that grow for 40 years, an average return of 10%, that money would turn into £537,000. But not everyone has 10k sitting around. So the majority of people may quid cost average their money each month into the stock market. Doing this is still great. It's actually fantastic because you'll be able to grow your investment pot over time and still let the compounding do its thing. Even if you had just £200 a month to put away for 40 years at the same average return of 10% per year, you would have £1.2 million in retirement. But this is the main takeaway here. Do everything that you can in your power to never take the money out that you've invested into the stock market. Keep investing what you can, and whatever other money you need for the short term, keep it in cash. And keep that emergency fund topped up so that you don't have to ever sell out of your investments to pay for a household expense. Live below your means. Stealth wealth is the best. To me, there is no point in buying a car that costs £700 a month in installments just because you can afford it. This is why you see plenty of people who make hundreds of thousands of pounds a year live paycheck to paycheck. Be better than the average consumer. Now, of course, this may be a lot to take in, and if it helps, keep watching this video back and forth so it makes sense. But don't get it twisted. There is no get-rich-quick scheme in investing that works. Day trading, reading Wall Street bets on Reddit, and watching a load of YouTubers' monthly stocks to buy lists will simply lose you money. Investing your money into the stock market consistently, into very, very good assets over extended periods of time will ensure that you'll be living very well in retirement. Keep increasing your income so that you have more disposable income left over each month. The more money you put in, the more money you'll have in decades' time. It's very boring, it's very dull, but it's very simple and you will be richer for it. Okay, so there it is, a complete beginner's guide to investing into the stock market for 2022 and beyond. As always, I really hope that you found some value in this video. If so, give it a thumbs up and let's have a discussion about it in the comments. If you haven't already, please do consider subscribing to the channel for more money-related content. Follow me on all of the socials down below for even more, and remember, until next time, every quid counts. See you soon.